Hello friends, welcome back to the channel. In this video, today we will talk about how to read the balance sheet of a company for investing. The objective of this video is to understand how to read the balance sheet and then do the necessary analysis so that we can evaluate if the company is good or not for investing purpose. So we will start with how to first understand how to read the balance sheet, and then we will go to the analysis part later, which we will do it through ratios. The basics that we should understand about the balance sheet is basically the balance sheet shows a balance between the asset and liabilities of a company. And this balance is demonstrated using a very simple formula. What is that formula? The formula is this: asset is equal to shareholders funds plus total liabilities. This is that balance sheet formula. And why it is called a balance? The balance between asset and shareholders funds and liabilities. Both sides should always be equal. There should be a balance between the asset and the liabilities and shareholders funds side. So that's why the term used here is balance. Now the second thing that we must understand about the balance sheet is, as we have understood from this equation, the balance sheet we can imagine as a two-column thing. On one side of the table we have assets, and the other side we have source of funds. If we will look deeper into the asset side lists what type of items. Suppose we are talking about a manufacturing company. So what are the assets of a manufacturing company? Suppose the company has a piece of land. So this land becomes one of the asset of the company, and the company also suppose has a building. So this building is also an asset of the company. Suppose the company also has various machines. So all these machines become the asset of the company. Suppose the company also has an office space in which it has various furnitures, it has computers, it has other small assets. So this office equipments also become a asset of the company. Suppose the company also maintains a few automobiles. It can be cars, it can be trucks, it can be forklifts, anything. So these automobiles also are the assets of the company. The company also must be operating under a brand name. So the name of the company that they have either copyrighted or whatever, so that brand name is also the asset of the company. All these things the company is doing, it has purchased a land, it has made a building, it has installed some machines, it has put some office equipments, it has bought some mobile equipments. All these are done for what? These are done to produce some goods and services, and all those goods and services must have been selling under a brand name. Suppose Nestle sells Maggie, so Maggie is a brand name of the product of the company. So again, there is another form of brand naming here, and those brand names are also, the product brand names are also the asset of the company. Another form of asset here is all this business that the company is doing. It is doing for what? It is doing to generate income. It is doing to earn some revenue, some profits. And where this profits in the form of money is kept, most of the money is kept in the banks. So all the money that has been kept in bank are also the assets of the company. This money that is kept in the bank, maybe they are not lying idle. Maybe they are lying as a FD or some investments. So all those FDs and investments becomes the assets of the company. So basically we can say that these assets can be categorized in two types. The company maintains its records of their assets under two heads. The first is non-current assets and the other is current assets. Under non-current assets, what type of items come? First, it will come the land, the building, the machines, office equipments, automobiles. All these are fixed type of assets, and they will come under the head non-current assets. Similarly, the current assets will be the cash they have kept in the bank, the liquid funds. The liquid funds means I'm talking about the liquid mutual funds that they have bought. They are also a type of cash, and we call it cash and cash equivalent. So those are all assets of the company. Another type of current asset are the investments of the company. All investments of the company, short-term investments of the company, they are also they will also come under current assets. Another form of current asset are account receivables. What are account receivables? These are nothing but the money that company has billed to its customers, and the customer has still not paid for it. It has been billed, but the payment has not been received. So all these type of things like cash, liquid mutual funds, investments, account receivables are accounted under current assets. So basically you can say that total assets of the company are equal to non-current assets plus current assets. So now we will move to the other column, which are source of funds. What are source of funds? Basically, we have seen that the company has maintained various assets under its balance sheet. They have bought some land, they have bought some buildings, they have bought some machines, they have bought some office equipments, they have also bought some automobiles like forklifts, cars, trucks, etc. They are also bought some raw materials, inventories to produce goods and services. All of this needs some money. From where that money is coming? So the account of from where those monies are coming, all those things are accounted on the other side of the balance sheet, which we have named as source of funds. So basically the company can generate money to fund its asset purchase in two types. Basically the company has two sources of funds. The first is the equity route. The second is the liability route. In the equity route, again, there are three types of equity. First is, we call it as share capital. When a company issues its shares to the public, that is the way of generating capital for the company. So the money that gets generated by issuing shares to the company in the form of an IPO are recorded as a share capital. The second form of equity are reserves and surplus. Now, reserves or surplus are basically the retained profits of the company. But some IPO money also goes under reserves and surplus. I will explain how. Suppose there is a company which has floated its IPO and the face value of the share is ₹1 and the company has, let's say, floated 100 crore numbers shares to the public. But during the issue of shares, the shares has been subscribed at a share price of ₹100. The face value was only ₹1, but the IPO subscribers have paid ₹100. So how this money will be accounted? So under the share capital head, some money will go under share capital and some money will go under reserves and surplus, that is also called as share premium. Let's see how this accounting is done. Suppose under share capital, if face value is ₹1 and number of shares issued is 100, so 100 crores will go under share capital and the balance ₹99, the investors have paid ₹100, so ₹1 is accounted under share capital and the balance ₹99 is accounted under share premium account. So 100 crores goes here and 9900 crores goes here. Okay. So you can see, you have understood now how the company has generated funds for itself by issuing shares and how those monies are accounted for. Some goes under share capital and others goes under equity premium under reserves and surplus head. The reserves and surplus are also the retained profits of the company. Let's understand this part also. Suppose there is a company which has generated a net profit of ₹100 crores. Out of 100 crores, it has decided that it will give 20 crores as dividend and the balance 80 crore it has retained. So this 80 crore that they have retained will go under reserves and surplus. Now this retained profits gets accumulated over the years. How? Suppose in year 1 the company made 80 crores. In year 2 the company made 70 crores and year 3 the company made, let's say, 100 crores. And all these values, let's assume they are after paying the dividends, means they are retained earnings. So the total of all these 3 years are how much? 80, 70, 150, 100, 250 crores. So in 3 years, the company has retained 250 crores. So where this 250 crores will go? This 250 crores will be recorded here under the reserves and surplus head. So again you see, under equity, by issuing IPO shares they have raised some money, and by also retaining some profits they have generated an equity funds for itself. The third form is basically, it is not a form of raising funds, but it is more a accounting restriction that has been asked by a SEBI for all companies to maintain like this. It is called as non-controlling interest or minority shareholding. What is this? Let's understand this as well. Suppose there is a company A that holds 80% shares of a company B, and the value of this company B, let's say, is 1000 crores. So what it is mandatory for this company A to record this 1000 crore under its non-current assets. So this 1000 crores will go under, the full 1000 crores will go under its non-current assets, the fixed assets that they have to show. But note here, the company A only holds 80% share in company B. The 20% is held by others. So in this 100 crore valuation, only in this 1000 crore valuation, 800 crores is of company A, but the balance 200 crore is of somebody else. So what the accounting rule says, that the full 1000 crores you must record here in the non-current assets, and the balance, and that 200 crores minority interest will go under NCI or minority interest section. So basically you can say, what is the total equity? What is the total equity of the company? It will be equal to share capital plus reserves plus non-controlling interest. So this is the total equity, which we also call as shareholders funds. Now the another form of source of funds are liabilities. Now under liabilities, again there are two types. First are non-current liability and the second is current liability. What are non-current liabilities? Non-current liability is the long-term borrowings. Means if a company has taken a loan, let's say for 3 years, so it will be recorded in the balance sheet of the company as long-term borrowing. The other form of non-current liability are deferred tax. The another form of non-current liability are provisions. So all these together make non-current liability of the company. So these are the ways for the companies to generate funds. They will borrow money from the bank. The tax that they could have paid this year, but they have deferred for the next year under the rule of law, whatever the law permits them. If they have to pay, let's say 100 crores in tax, but the law says that you can pay 80 crore now and balance 20 crore you can pay later. So that becomes a kind of a deferred tax. So this is also a way of generating funds for this year. Provisions. Provisions are also a kind of non-current liability of a company, because let's say a company is fighting a case, and the case, let's say if they lose, they will lose rupees 100 crores. They will have to pay rupees 100 crores to somebody. So what the company does, as soon as the case starts, they will keep those 100 crores as a provisions, that in case we lose the case, those 100 crores we will pay from this provisions head. So these are the forms of non-current liabilities. Now under current liabilities, again we will have mainly two types of funds. First is the short-term borrowings. These are those loans that the company has taken from a bank, and let's say they have promised that we will repay this loan in next 6 months, 8 months and whatever. Any loan taken for a period which is less than 12 months are short-term borrowings. The other type of current liability can be trade payables. What are trade payables? Trade payables are nothing but the bills that the company has to pay to its vendors, the bills that they have to pay to pay its utility bills and other things. So these are basically two types of trade payables. This is what a balance sheet of a company looks like, where the main focus is assets and the source of funds. And what are assets? Assets can be of non-current in nature and current in nature. And the source of funds can be from equity and from liabilities. Once we understand this structure of the balance sheet, we are now ready to do some analysis thing. And why we are doing this analysis? Because we want to understand if this company is good enough for investing or not. to do the analysis, we will use three ratios: ratio number 1, ratio number 2, ratio number 3, and other is a growth metric. The first ratio that we will use is called current ratio. The second ratio that we will use is debt to equity ratio. The third ratio that we will use is price to book value ratio, and the growth metric that we will use is asset growth. What is the function of current ratio? The current ratio we will use to check if the company is liquid enough or not. The debt equity ratio we will use to check if the company is sufficiently solvent or not. So what is the difference between liquidity and solvency? Liquidity tells you that if the company has sufficient money, sufficient current assets, sufficient cash in its bank to pay its current bills or not. Suppose there is a company which has to pay a lot of money to its vendors and it is not able to pay. Suppose this company also has to pay a lot of EMIs back to the bank, but it doesn't have cash to pay. What will happen? It will go in bankruptcy. So it is very important to check if the company has sufficient liquidity, sufficient cash to pay its immediate expense or not. So how to find if the company is capable enough or not? For that we will have to we will have to do the liquidity check, and to do liquidity check, one of the good ratios is current ratio. Now, what is solvency? Solvency means this is a ratio that tells you that how dependent the company is on debt to fund its asset purchase. Suppose there is a company which is doing fantastic business. It has a big land, it has nice building, nice machines. It is also producing fantastically, and let's say it is producing 100 crores of profit each year. But the debt in the balance sheet of the company, let's say, is 1000 crores. If you are making only 100 crores profit, if you have only assets, let's say, worth 100 crores and you have 1000 crores worth of debt, it's not good. So how to check that? That kind of check is called solvency check, and one of the metrics that we can use to do that solvency check is debt to equity ratio. The third ratio, the price to book value ratio, is a valuation ratio, where what we do, we check if the current share price is valued in accordance with the company's assets or not. And the one way to do it is by finding the price to book value ratio. The fourth form of metric that we use to do the balance sheet analysis is the asset growth. We want to understand here that if the company is growing at a reasonable growth rate or not, because ultimately all stock market investors want to invest, number one, in a fundamentally strong company, but that company should also be growing at a sufficient speed. So one of the way to check the growth of the company is by checking how fast the assets of the company are growing. Coming back to the ratio number 1, how to calculate current ratio? The current ratio can be calculated by finding a ratio between current assets and current liabilities of the company. So where you can find current assets? You see, under the asset column, we have seen there are two types of assets, non-current and current assets. And what were the current assets? The cash, liquid funds, investments, account receivables, these are all current assets. So this value, the total of all of this value you can carry and use it as current assets. Where you will find current liability? The current liability you will find, you see, we have seen the liabilities are of two types, non-current and current liabilities. So the total of all of this will come as current liabilities. So once you have found this ratio between current assets and current liabilities, suppose this ratio comes out to be more than 1. So as a rule of thumb, if the current ratio is more than 1, we can say that it is a good ratio. Good ratio means the company has sufficient funds to pay its current liabilities. The higher the current ratio, the better. But generally, as a rule of thumb, ratio between 1 and 2 are considered good. Now let's come back to the ratio number 2. What is ratio number 2? Debt equity ratio. What is debt equity ratio? It is total borrowings divided by shareholders funds. Where to find total borrowing? Again, you can see total borrowing you will find under the source of funds side of the balance sheet, where you see there was one item called non-current liability. Under non-current liability, we have recorded one item as long-term borrowing and other was short-term borrowing. So the total borrowing will be long-term borrowing plus short-term borrowing. So this we will take from here and put it here in this equation. Where we will find shareholders funds? The shareholders funds, again, you can find under the source of funds side, and you will find it here. What is source of funds? Share capital plus reserves and surplus plus non-controlling interest. So you can see the shareholders funds we have found, it is share capital plus reserves and surplus plus non-controlling interest. So this shareholder funds you will take from here and put it in this ratio. Now suppose there is a company whose debt to equity ratio has come out to be less than 0.33 or 0.3 you can say. So this is again a number that we can say that the company is good. The lower the debt, the better. A debt free, I personally like debt free companies, but there are some companies, they are so capital intensive that they cannot afford to remain debt free. So they will have to buy some debt from the market. But if the debt level is less than 0.33, it feels good, it feels comfortable from the investor's perspective. Yes, you can say that there are few companies like cement, steel, automobiles, infrastructure. These are very capital intensive companies. For them, maintaining a debt equity ratio of 0.3 is not possible. For them, the allowable limit can be between 1 and 2. So if I'm an investor and I am looking at a very capital intensive company, so if those capital intensive company, even if they maintain a debt equity ratio of less than 2, I will say that it is a reasonable ratio. The third ratio here is the valuation ratio, which is price to book value ratio. How to calculate price to book value ratio? The formula for it is market cap divided by shareholders funds. So we know where to find shareholders funds. We have seen in this equation, we have seen where to find shareholders funds. How to find market cap? There are two ways to do it. First is, let's understand what is market cap. The market cap is nothing but the price of shares into the number of shares issued. This is the market cap. So you will get the price of share from NSE, BSE portals, or also from money control type of website. And how to find number of shares? The number of shares you can find, you remember we have recorded under the source of funds column, we have recorded a metric called share capital. So we will use this number to calculate number of shares. How to do it? The number of shares will be share capital divided by the face value of the share. And where to find the face value? The face value again you can find from these websites, from National Stock Exchange website, from BSE, or from the money control type of website. So this will give you the number of shares. So once you have the market cap of a company and you divide it by shareholders funds, you will get a ratio which is called price to book value ratio. The lower the price to book value, the better is the valuation of a company. Now again, this is just a thumb rule. But all companies, by the nature of their business, all companies cannot maintain a very low price to book value ratio. For a very capital intensive companies, suppose we are talking about three types of companies. Okay, some companies like Tata Steel, maybe Tata Motors, and let's say TCS. There are three types of companies. Tata Steel and Tata Motors are very, very capital intensive companies. Tata Motors is an extremely capital intensive company, and TCS is a kind of a service based company, so they are not so capital intensive. So for a Tata Steel type of company, which is capital intensive but not like a automobile company, you will see that their price to book value ratio generally remains at 2 or 3 levels. For Tata Motors, it can even go down to less than 2, and for TCS type of companies, those price to book value ratio can be more than 10 also. So we cannot say that a company whose price to book value ratio is less than 2 is good, and a company whose price to book value is more than 10 is not a good company. Depending on the type of company, the price to book value ratio changes. So you have to understand the company is operating under which sector, which industry, and then you have to compare the price to book value ratio of that company with its competing companies to understand if the valuation of the company is good or not. Finally, in the balance sheet analysis, what we will do? We will do the growth analysis. How we will do the growth analysis? Suppose in year 1, the company had an asset of, let's say, 100 crores. And by the year 5th, its asset size has grown to 200 crores. So in 5 years, the company's asset has doubled. It has become 2x. So how to find the growth rate? To find the growth rate, we will use the CAGR formula, which will be equal to 2 times to the power 1 divided by 5. 5 is the number of years minus 1. So in this case, this value will be approximately equals to 14.8%. So we can say that in these 5 years, the company has grown its assets at the rate of 14.8% per annum. So you can see how we have understood that what is a balance sheet. The balance sheet is nothing but is a balance between the asset and shareholders fund and liability of a company. How the company do the accounting in the balance sheet. They maintain two columns. First is the asset column, the other is the source of funds column. And once all these accountings are done, we as investors can use, for example, these 4 types of metrics to do the balance sheet analysis.